trillion more than the entire world derivative market in 2000. Now the derivative market, which is my specialty, I've traded for 32 years. In 2000, when Greenspan mentioned, this $80 trillion a year market, well, one thing he didn't mention was government was probably writing 65% of the paper in that market. A derivative transaction, a lot of people have a hard time, well, what's a derivative transaction? I can't understand it. It's actually very simple. Okay? There's a, see that cooler up there, the little green cooler? If I wanted to buy it 6 months from now and I said, okay, I'll pay you $2, but say the value of it's like, say, $15. I'll pay you $2 now, and 6 months from now, I'll give you the other 13, and I own it. And she signs a contract for me. I give her $2. She goes, that's a good deal. But I know water bottles are going to go right through the roof. That'll be worth $30 in 6 months. So I give her $2 now. 6 months from now, I buy it for $15. Doesn't matter if they're buying for $30. I've locked her into a contract. Now, in that water bottle, say for example, she hears, I want to buy it for $15. She goes, well, I know water bottles are going to go down to 50 cents. China's coming in and selling them for a quarter 6 months from now. Okay, I sign a contract, $2 changes hands. I'm kind of forced to buy it at 15. If the price starts going down to $1, I just got stuck for $14. So a derivative contract is time. You're buying 5 months, 6 months, a year, 2 years, whether it be gold, silver, cattle, wheat, corn, soybeans. You're making a commitment on time. Okay? And you're locking in the financial responsibility. If you're a seller and the price goes down first, you buy it back, you collect the equity difference. If you think the price is going up, you buy it first, price goes up, you sell it, closing out the trade, and you walk with the equity difference. So a derivative contract, when you execute it, you're looking for the price to go up or down. You can sell first, buy first. Doesn't matter, you do a gold futures contract, doesn't matter if you have 1 ounce of gold. You could be sitting there selling 1,000 contracts. Okay? By the way, on that derivative report for JP Morgan Chase, I looked, I think it was table 13 or 14, it showed their gold futures position. They were holding $87 billion worth of gold derivative contracts, mostly short. They sold first. It was right before the collapse. And what happened at the end of 2008, after 9/11, when the World Trade Centers got hit, which I was extremely mad about. I wanted to bring my son there for lunch when he got older, but never had a chance to. But before this, 8, 9, 10 months before it, I watched in the Wall Street Journal, they show institutional fund short derivative positions against physical holdings. The normal ratio is 18%, high side was 30, 35%. Well, 8 months before it had broken 40%. So something's up. 3 months before 9/11, it hit 60%. Hedge short. Okay? Well, when 9/11 occurred, the stock markets worldwide collapsed for 2 or 3 days. And for 2 or 3 days, the markets collapsed 4 days, 5 days. And people said, well, who profited from this? And all of a sudden it pops out in the paper. Someone didn't claim a $5 billion put option on American Airlines. This must be the people behind 9/11. $5 million is chump change on chump change on chump change. Okay? The bond market, which I was actually trading at the time, 4:30 in the morning Arizona time, all of a sudden I watch, boom, up a point. It moves in little ticks. A full point is 30 seconds of a point. Up a point and a half, down a point and a half in seconds. What the hell? I looked at the front page of AOL, see Tower 1 burning. Okay? Well, the number one profiteer off of 9/11 were the government institutional managed funds that had their short derivative positions on. They took a loss in their physical positions, but their short derivative positions made a killing, trillions of dollars in a very short period of time. Now, government also outsourced, a lot of their management funds. CalPERS International in '82 was one of the largest. And by the way, CalPERS was getting closer to $1-2 trillion dollars back in the '80s. Okay, California. and it was getting too obvious that much money under management, we got a problem here. CalPERS started recommending to local governments that they manage their own funds, go to separate management, get out of CalPERS. Or they started CalPERS International in '82, and then they recommended to actually all local government pension fund managers across the country, your local governments have very peculiar rules. You're not allowed to trade derivatives, futures, calls, puts, stock options, advanced foreign currency contracts. This can cost you billions of dollars. CalPERS, which has an excellent management record for 65 years, has just gone to CalPERS International, and in so many words, if you participate with them, you will not be subject to those pesky little rules. Okay, so they consolidated, directed management participation to go to CalPERS International. Now, CalPERS International is a transfer agent. It's set up as a transfer agent. If you get their comprehensive annual financial report, it always shows low balances, 39 billion, 51 billion, 49 billion. That's because they're showing what's in the process of going out for assignment or coming back for distribution. They've actually assigned Credit Suisse, Deutsche Bank, Millennium Fund 1, Millennium Fund 2, a few $1 trillion. Okay? Outside of the dollar, outside of mandatory investment in the United States, local government pension funds were restricted from only having a very small percentage outside the dollar, invested in Asian, European companies, and so forth. And they kept raising that up over the decades. The bottom line came down to easy money, profit motive, public sitting there off in la-la land, government bringing in hundreds of billions of dollars a day. Okay. I mentioned the gross income government. 2007 collective government, local and federal, tax income between both was about $5 trillion. Investment income, a little over 6-point-something trillion. Enterprise income, total gross income was about $14 trillion for government in 2007. Tax income, investment income. Investment income is actually first now. Tax income comes second, then enterprise income. 14 trillion. The entire population of the United States, Bill Gates, guy working at McDonald's, investment income, salary income was about 10 trillion. If you take off direct and indirect taxation, indirect's very important, big chunk there, that was about 5 trillion, as I mentioned. So that gave the public net income after taxation of $5 trillion. So here you have government grossing 14 trillion, the population bringing in 5 trillion net after taxation, or Russia's dream of the 40s. Or, hello, comrade,